There are massive, rapid changes happening in the financial world. First Republic Bank collapsed and JP Chase acquired it. The Fed raised interest rates by yet another 1/4 percentage point, the 10th consecutive rate hike, but they've hinted that there might not be an 11th. The jobs report is still strong despite the high-profile layoffs. Inflation is hovering around 4%, which is a huge improvement, but still double the target rate, and the market is as volatile as ever. What does all of this mean for you? How can we make sense of this cacophony, separate the noise from the signal, and understand what to do with this information? We're going to chat about that today. Welcome to the Afford Anything podcast, the show that understands you can afford anything, but not everything. Every choice that you make is a trade-off against something else, and that doesn't just apply to your money. That applies to any limited resource you need to manage: your time, your focus, your energy. So, what matters most, and how do you make decisions accordingly? Those are the big picture questions that this podcast explores. In today's episode, we're going to do something a little bit different than what we normally do. I'm recording this on Thursday, May 4th, 2023. We are going to talk about the current market, the current financial and economic environment. We're going to talk about that for the first 10 minutes. After that, we will replay an interview with acclaimed financial advisor Michael Kitces. Whether you're a longtime listener or new to the show, welcome. I am your host, Paula Pant. And let's start by talking about the banking collapse. What are the key points you should know? And how does this affect you? Now, first of all, the collapse of First Republic Bank was the big story of the week. For those of you who are or were First Republic Bank customers, rest assured that your deposits are fine. You're effectively a JP Chase customer now. Second, although the First Republic collapse came on the heels of the breakdown of both Silicon Valley Bank and Signature Bank, the overall banking sector, particularly the big national banks, are stable. The weaknesses that we have seen in the system have impacted regional banks, primarily the regional banks that serve high net worth individuals and companies based in high cost of living coastal cities. First Republic Bank had branches that were concentrated in high cost coastal areas. Silicon Valley Bank obviously serves its namesake area, or it used to. Now, seeing these regional banks collapse has caused a crisis in public confidence in particularly regional banks. There is an index called the KBW index, which is essentially an index fund that tracks banking stocks. It includes 24 publicly traded banks, including regional banks. And that index fund right now is in the toilet. It suffered huge losses this week. It also, of course, dropped substantially in mid-March after Silicon Valley Bank collapsed. And in addition to that index fund, there are, of course, stocks for specific individual banks that have dropped by as much as 20%. And so to the extent, and granted, the stock market does not necessarily reflect public opinion, but to the extent that we can use what's happening in the markets as a proxy for general sentiment, the KBW index would indicate that people are pretty shaken. And in addition to that, the net outflow of deposits from banks that started, again, in mid-March when Silicon Valley Bank collapsed, there's a net outflow. More people are shifting to money market funds. That's been the unexpected winner. Money market funds have seen a boom, a huge inflow since all of this started. Now, at the macro level, policymakers are going to have their public debates about systematically what to do from here. Should the FDIC increase the stated amount that it covers? Should smaller regional banks in particular be held to the same set of regulations that the big banks are? What about shadow banks? Where do they fall into the picture? So at the macro level, you hear people talk about these questions. But at the individual level, what should you do? How do you protect and preserve your own money in the face of all of this? Well, number one, rest assured that in all three of these banking collapses, depositors, people like you and me, have been protected. Number two, however, it is wise to make sure that your deposits at any one given institution, or especially in any single member account, stay under the $250,000 FDIC limit. Now, most people who are listening to this are like, yeah, great, thanks, Paula. why would I have $250,000 just sitting in an account? But if you are a small business owner, it's entirely likely that you would have more than that 250K. You would have uninsured deposits because as a small business owner, that's payroll. Those are your operating expenses. Likewise, if you're a real estate investor, maybe you did a cash out refi on one of your properties, and now you've got that money sitting in an account while you're trying to figure out which property you want to buy next. So for many entrepreneurs, many investors, even small scale mom and pop operations, it's entirely reasonable that you have deposits that are in excess of what the FDIC would insure. And I think if there is a takeaway from watching this, it's that if you are dealing with accounts that have such large numbers, it is probably a good idea to spread that money among different institutions. Not because I think that anything is going to happen. I think the worst of it is behind us for this chapter, but simply as a matter of diligence and protocol. But for anyone listening who is not an entrepreneur, is not a real estate investor, or maybe you've just started, you're in the initial phases of your side hustle, things haven't quite taken off yet. For anyone who's listening who has accounts with fewer zeros at the end, there's no reason for anxiety. Now, one thing that's interesting about this banking collapse is that we're seeing more consolidation in the banking sector. We're seeing big banks get bigger. Under normal circumstances, regulations prohibit any one bank from holding more than 10% of the total number of deposits across the nation. But these are not normal circumstances. We've seen this happen before. We've seen this happen in 2008. In March 2008, JP Chase acquired Bear Stearns, which was one of the biggest global investment banks. 6 months later, in September 2008, JP Chase, which is headed by Jamie Dimon, bought Washington Mutual, WAMU, which was the biggest savings and loan association in the U.S. at the time. And similar to First Republic, WAMU was also seized by the FDIC. And so fast forward to last week, and I actually have a personal story about this. So last Thursday, April 27, I was lucky enough to be one of 12 people who was invited to have dinner with Jamie Dimon, the chairman and CEO of JP Chase. So that was exactly 1 week ago. The 12 of us who were having dinner with him are the people associated with the Business and Economics Journalism Fellowship that I'm part of this year. It's called the Knight Bagehot Fellowship at Columbia University. I'm limited in what I can tell you about that dinner, but I can say 3 things. One, I can tell you that for weeks prior to the dinner, we, meaning every single fellow, all of my fellow Knight Bagehot fellows, we took very seriously the task of thinking about what questions we wanted to ask. So that's one of 3 things I can tell you. The second is that I can tell you we had plenty of opportunity to ask whatever we wanted. And the third thing that I can tell you is that I was pleasantly surprised and impressed by his openness and his frankness. That dinner, and I posted photos from that dinner on Instagram. I'm on Instagram at Paula. Oh, it was in my Insta stories. Oh, no, it was on the post too. Anyway, I'm on Instagram at Paula Pant, Paula, Pant. Follow me there. So that was Thursday. And then 2 days later, the Wall Street Journal broke the story that JP Chase was expected to most likely win the bid for First Republic. That was first reported in the Wall Street Journal on Saturday. Then Sunday overnight, one of my fellow fellows was tracking this really closely. We have a WhatsApp group, and he posted at like 3 a.m., 4 a.m. to our WhatsApp group. He was basically posting in real time as the public information broke. That was when it became official that Chase acquired First Republic and that the face of banking will look different from here on out. But, Jamie Dimon did a conference call with his investors on Monday that it was public. He made public remarks. in which he said that this part of the crisis is over, meaning that the banking system is stable. And that doesn't necessarily mean that the U.S. economy as a whole is going to be rainbows and unicorns from here on out. In fact, in early April, he made public remarks warning about storm clouds ahead. But it does mean that for you, for me, for ordinary individuals, the bedrock of our ability to participate in the financial system is our confidence in institutions continuing to exist. And while we have seen 3 banks collapse, the indications point to the worst being over and the banking sector as a whole being stable. It's funny that this even has to be a discussion because it is so foundational, so fundamental. It's something that we typically take for granted. You know when there is confidence in the banking system because nobody is talking about it. It is that taken for granted. It is that foundational. And it looks as though we can get back to not talking about it. So, on that note, let's talk about one of the major factors that led to all of this, inflation and interest rate hikes. That was the other news from this week, although it wasn't even big news because this has become de rigueur at this point. But the Fed raised interest rates by another 0.25 percentage point. Now, the Fed tends to meet roughly once every 6 weeks. They generally meet around 8 times a year. This is the 10th consecutive meeting at which they have raised the federal funds rate. And that, by the way, is one of the reasons that we're facing such turmoil in the banking sector, because these rapid rate hikes had the effect of weakening bank balance sheets, which led to everything that we've just talked about for the last however many minutes. The good news is that the rate hikes have put the brakes on inflation. It's now hovering around 4%, and that's a huge improvement from where we were a few months ago, but it is still double the target rate. So there's a possibility in the far future, and by far I mean maybe in the fall, in the winter, there's a possibility that there might be more rate hikes, depending on how inflation looks 3 months, 6 months, 9 months down the road. But the Fed has signaled that they might cool it for a while. They might not hike the federal funds rate for an 11th consecutive time. So for the time being, at least, for the early to midsummer, we can anticipate interest rates staying relatively steady. So again, how do we apply that information? What should you do with that knowledge? Well, higher interest rates mean that the interest rate on everything from your credit card balance to your car loans to your mortgage is going to be higher. Of course, if you have a credit card balance, one of your top priorities should be crushing that as quickly as possible. And that has nothing to do with what's happening with the Fed. That's just a universal. When it comes to your mortgage, though, the question gets a bit more interesting because there is a stronger argument to be made right now for getting an adjustable rate mortgage if you're in the market to buy a home or buy a rental property. For the last decade, when interest rates were low, a fixed rate was hardly even questioned. It was, at least anecdotally, among the students in my rental property investing course, it was just assumed that you would lock in a fixed rate. These days, however, we need to get a spreadsheet involved, and we need to start making some assumptions and testing some best case, worst case, and medium case scenarios. I won't go too far down the rabbit hole on this fixed versus adjustable rate topic, because that could be an entire episode in itself. But I will say that if you opt for an adjustable rate, there are a few things you must know. First, you need to know how long your initial rate is locked in. Second, you need to know how often your rate will adjust. Third, you need to know how much your rate could adjust by during any singular adjustment. And you should know that in two forms. You should know that in terms of percentage points, and you should also know that in terms of what it means for your monthly bill. And then the fourth thing you should know is how bad can it get? What is the highest possible rate that your adjustable rate mortgage could go to, and what does that mean for your monthly payment? And bear in mind, when you're asking the question, what does that mean for your monthly payment, remember, your principal balance is not going to change. The adjustable rate changes the interest, but then there are also two other wildcard variables, the property taxes that you pay and the insurance that you pay. And both of those could go up, and that could have significant consequences to your monthly payment as well. So you'll want to leave some margin of error there, because if in the worst case scenario, your adjustable rate mortgage hits the maximum that it is contractually allowed to reach, if that's going to create a principal and interest payment amount that would put you on the brink, assuming steady taxes and insurance, well, then that's no good, because then all your county has to do is hike the property taxes or hike the assessment on your property, and boom, now the bill is bigger than what you can handle. So the takeaway is that there is a stronger case to be made for adjustable rate mortgages, but you're going to want to spreadsheet the heck out of that possibility before you sign on the dotted line. All right, so that is a bit of a synopsis on what's happening right now. Again, I'm recording this on Thursday, May 4th, 2023. As I mentioned, I'm doing this fellowship at Columbia in business and econ journalism, and it is currently finals week. My friend referred to it as Deadline Inferno. So I'm currently living in the middle of Deadline Inferno, final projects, final papers, lots of deadlines. So I'm sorry we couldn't record a fresh interview or a fresh Ask Paula and Joe episode as we normally do. And we've skipped having a bonus episode for both the month of April and the month of May of 2023. Typically we do a First Friday bonus, but right now I have exactly 13 days between now and graduation, and it is a belly flop across the finish line, running the gauntlet, powering through the inferno. Insert your favorite metaphor here. It's rough. So for the rest of this episode, we are going to play an interview from our archives. This is an interview with financial advisor Michael Kitces, in which he talks about the importance of investing in your human capital, which is precisely what I'm doing at this program here. So I hope you enjoy the episode. Michael Kitces is brilliant and one of the most respected financial advisors out there. And he was kind enough to speak to us back when we were a brand new show. We originally recorded this interview as episode 64. Can you believe that? Back when we were double digits. So for the rest of the episode, we will play that, and we will return to our normal episode release schedule. We'll return to doing First Fridays again. We will return to normalcy after I graduate, which is, as of the time that I'm recording this, exactly 13 days from now, assuming that I don't botch anything spectacularly in the next 13 days. Thank you for being part of this community. Enjoy this upcoming replay of our interview with Michael Kitces. Come say hello to me on Instagram at Paula Pant, PaulaPant. And I will catch you in the next episode. Here is financial advisor Michael Kitces discussing how your mind is more powerful than money. Hey, YouTube family. So if you have made it all the way to the end, you've heard me cue up this interview with financial advisor Michael Kitces. And in the version of the podcast that we air on Spotify, on Pandora, on Apple Podcasts, in that version, the Michael Kitces interview would play right now. The audio would flow right into that. But YouTube doesn't allow us to republish the same interview twice. We can't put duplicate content on YouTube. And since we've already aired the Michael Kitces interview on YouTube, we can't rerun it. So instead, we're going to drop a link in the description to the Michael Kitces interview, which was episode 64. I strongly encourage you to check it out because he is a brilliant financial advisor, and he talks about the comparison between investing in assets such as stocks or real estate or companies, private companies, versus investing in your own skill set, in your own human capital. And because he is such a well-regarded financial advisor, he comes at this with thoughtfulness, with nuance. So the link is below. Enjoy the interview. Thanks for being part of the YouTube family. We're going to be sharing lots more on YouTube in the coming months ahead. Leave a comment if any part of this episode caught your attention. Leave questions, leave comments. I'd love your feedback. Thank you so much for being part of the Afford Anything YouTube family. And I'll catch you in the next episode.